webinar event. Good afternoon. Welcome to the National Fair Housing Alliance webinar event, celebrating 50 years of the Equal Credit Opportunity Act. I am Chopra Bailey, and I serve as NFHA's Executive Vice President. NFHA is the nation's only national civil rights agency solely dedicated to eliminating all forms of housing discrimination and the trade association of over 200 fair housing and justice-centered organizations and individuals throughout the United States. We are excited about today's session, where we'll hear remarks from the United States Attorney General, the Director of the Consumer Financial Protection Bureau, and the Assistant Attorney General for the Department of Justice's Civil Rights Division. They will be followed by a moderated discussion led by MSNBC's Anthony Cooley with a superb panel of fair housing and lending experts. To get started, I would like to introduce you to NFHA's President and CEO, Lisa Rice. Lisa leads NFHA's efforts to advance fair housing principles, preserve and broaden fair housing protections, and expand equal housing opportunities for millions of Americans. She is a published author contributing to several books and journals on a range of fair housing and lending issues, and led efforts to establish the Office of Fair Lending within the Consumer Financial Protection Bureau as a chief crafter of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Under Lisa's leadership, NFHA investigated and resolved precedent-setting fair housing cases, which have resulted in providing remedies for millions of people, as well as the elimination of systemic discriminatory practices involving lending, insurance, rental, and zoning matters. She has received numerous honors and awards and was recently named one of Time's 2024 closers. Lisa, over to you.
Nikitra, thank you so very much for that kind introduction. And I too want to thank all of you for joining our ECOA at 50 virtual event. This nation should be extremely proud that we have some of the strongest civil rights protections in the world. And it is my distinct privilege and honor to introduce someone who has taken his oath to uphold our nation's fair housing and fair lending laws very seriously. Merrick Garland is the 86th Attorney General of the United States of America. He serves as our country's chief law enforcement officer and leads the Justice Department's 115,000 employees who are working throughout the nation and the world to protect the civil rights of all Americans. He has helped lead the DOJ in implementation of its Combating Redlining initiative and also in advancing fair housing and fair lending practices by enforcing both the Fair Housing Act and, of course, the Equal Credit Opportunity Act. Attorney General Garland, I just want to thank you so much for your incredible leadership and for joining us and being a part of today's commemoration.
Good afternoon, everyone. Thank you, Lisa, for your extraordinary leadership of the National Fair Housing Alliance. And thank you for inviting me to joining you in marking 50 years since the enactment of the Equal Credit Opportunity Act. I'm joining you this afternoon from the Justice Department's headquarters in Washington, D.C., the Robert F. Kennedy Building, often referred to as Main Justice. Everywhere you look in this building, from the architecture to the art to the words inscribed on its walls, there are reminders that this place is meant to be a monument to justice. But this building was constructed at the height of the Great Depression in the early 1930s. That meant that at the same time the federal government was building this monument to justice, it was engaging in the deeply unjust practice of redlining. As this very building was being constructed to facilitate the Justice Department's work to pursue equal justice under law, government agencies were denying Black Americans equal access to credit services to obtain home ownership. Much has changed over the last century, thanks to the work of generations of lawyers and advocates within and outside the Justice Department. But as you well know, redlining and discrimination in lending are not relics of the past. Indeed, the Justice Department has brought multiple cases in recent years alleging that financial institutions redlined some of the same neighborhoods that federal agencies originally redlined in the 1930s. That is why, in my first year as Attorney General, we launched the most aggressive, farthest-reaching effort to combat redlining in the Justice Department's history. When I announced the Combating Redlining Initiative over 3 years ago, I said the department would commit itself to making far more robust use of our fair lending authorities under the Fair Housing and Equal Credit Opportunity Acts. I said we would strengthen our partnerships, both within and outside of the department, to proactively determine if lending institutions were engaged in redlining. And I said that if fair lending violations were discovered, the Justice Department would act. That is exactly what we have done. Over the past 3 years, the Justice Department has secured 15 settlements with lending institutions and $152 million in relief for redlined communities. This historic relief is expected to generate over $1 billion in investment communities of color in redlined communities. In New Jersey, we filed a complaint against Ocean First Bank for engaging in a pattern or practice of lending discrimination by redlining predominantly Black, Hispanic, and Asian neighborhoods. We secured $15 million in relief from the bank to provide access to home mortgage, home improvement, and home refinance loans for residents of those communities. In North Carolina, we filed a complaint against First National Bank of Pennsylvania. We secured a $13.5 million settlement from the bank that will expand access to credit services for Black and Hispanic neighborhoods in Charlotte and Winston-Salem that have been denied them for too long. In Florida, we filed a complaint against Ameris Bank for redlining some of the same neighborhoods in Jacksonville that were first redlined by government agencies nearly a century ago. We reached a settlement requiring the bank to pay $9 million to expand access to credit opportunities for residents of those neighborhoods. In Rhode Island, we filed a complaint against Washington Trust Company. We secured $9 million in relief for majority Black and Hispanic neighborhoods that had been denied access to mortgage lending services. In California, we filed a complaint against City National Bank. We secured over $31 million in relief, the largest redlining settlement in department history. As part of our settlement agreements, we have also required lending institutions to expand access to their services by opening a total of 23 new branches or offices in communities across the country that have been harmed by discriminatory lending practices. These numbers are significant, but they do not capture what these resolutions look like in people's lives. They look like the story of Ms. Veronica McCrae, who received a loan subsidy after the Justice Department obtained a settlement with Cadence Bank in 2021. Before the settlement, Ms. McCrae was renting an old house in which a floor had fallen in. After the settlement, Ms. McCrae was able to put the loan subsidy funds toward a down payment on a house that is within walking distance of her daughter's school. She is now paying less per month on her mortgage than she was paying on her rent. Ms. McCrae said, quote, "Having my own home has changed my life. The most wonderful thing about owning my own home is the amazing effect it has had on my family. We now have enough room that I can have my sons and my grandchildren over for family gatherings. It's also a wonderful feeling to know that I can leave something to my children and grandchildren," close quote. For Mrs. Crystal Randolph, who also received a loan subsidy because of the department's settlement with Cadence Bank, it has meant buying her first home. She shared that her kids have their own rooms for the first time, and she is thinking about growing flowers in her yard. I am extremely proud of the work of the Justice Department that has been done to combat redlining and secure relief for the communities it has harmed. This year, we mark not only the 50th anniversary of the Equal Credit Opportunity Act, but also 30 years of redlining enforcement by the Justice Department. In 1994, the department filed its first redlining case right here in Washington, D.C., against Chevy Chase Federal Savings Bank. I am grateful to the public servants of the Housing and Civil Enforcement section of the Civil Rights Division, without whom none of this work would be possible. And I particularly want to recognize Assistant Attorney General for Civil Rights, Kristen Clarke, for her leadership of the Combating Redlining Initiative and for the work she does every day to advance the department's founding purpose to protect civil rights. I am also extremely grateful to Director Chopra and his entire team at the Consumer Financial Protection Bureau for their leadership and partnership in these efforts. Here's just one example of what that partnership looks like in practice. Last December, the Justice Department and the Consumer Financial Protection Bureau filed a lawsuit against Colony Ridge, a Texas-based developer and lender. We allege that Colony Ridge targeted Hispanic consumers with predatory loans, misled borrowers about the water, sewage, and electrical infrastructure on its lots, and exploited language barriers by conducting most of its marketing in Spanish while offering important transaction documents only in English. Discrimination in lending harms families and neighborhoods for generations. The suit alleges that Colony Ridge sets borrowers up to fail with loans they cannot afford. Roughly 1 in 4 Colony Ridge loans ends in foreclosure, after which the company repurchases the properties and sells them to new borrowers. This kind of alleged conduct is wrong. It is illegal, and it is an example of why combating redlining requires our constant vigilance. The harm that redlining does cannot be solved with a single settlement. Redlining is not just an illegal practice inflicted on individuals, it is one inflicted on generations of families. It has contributed to and continues to deepen the persistent wealth gap in our country. The Justice Department recognizes that combating redlining and repairing the harm it causes require our continuing work and our continued vigilance. We also recognize that this is not the work that the enforcement agencies can do alone. That is why I'm so grateful to the National Fair Housing Alliance for your advocacy, your research, your commitment to ensuring fair access to credit, and the valuable insights you have shared that help make the Combating Redlining Initiative a success. And to everyone joining today's convening, advocates like you have played a critical role in combating lending discrimination under the Equal Credit Opportunity Act and other laws over the past 50 years. From filing lawsuits to holding lenders accountable to publishing resources on how to identify redlining, your work could not be more important. On behalf of all of us at the Justice Department, thank you for your partnership. And thank you for all you will continue to do alongside the exceptional public servants of the Civil Rights Division to make real the promise of the Equal Credit Opportunity Act.
Thank you so much, Attorney General Garland, for your leadership and commitment to civil rights. And thank you so much for those just incredible remarks and recognizing the work of civil rights organizations to work alongside the Department of Justice to enforce our nation's civil rights laws. And at this time, I would like to ask for Director Rohit Chopra and Assistant Attorney General Kristen Clarke to join me on the stage. And I think we're still waiting for Rohit to join us as well.
I'm here, Lisa.
Okay, great. So it's now my distinct privilege and honor to introduce to our audience 2 great champions of justice, and probably 2 of the people who have the most responsibility for enforcing the Equal Credit Opportunity Act. Rohit Chopra is the director of the Consumer Financial Protection Bureau. He is also a member of the board of directors of the Federal Deposit Insurance Corporation and the Financial Stability Oversight Council. Prior to joining the CFPB, Director Chopra served as a commissioner on the Federal Trade Commission. And those of us who have been in the fair housing movement for a number of years will remember how when he was in that role, did just such an amazing job to promote and advance and support the use of disparate impact to address nefarious activity by people who were violating our civil rights laws. I also want to introduce Kristen Clarke, a long, dear friend. She is the Assistant Attorney General for Civil Rights at the U.S. Department of Justice, where she leads an extremely robust docket of investigations and cases on issues ranging from criminal justice reform to fair housing and fair lending. And of course, prior to joining the DOJ, Kristen was the president and CEO of the venerable National Lawyers Committee for Civil Rights under Law. Director Chopra and Assistant Attorney General Clarke, thank you both so much for joining me and for the great work that you're doing to help advance the Equal Credit Opportunity Act.
It's great to be here. Thank you.
Thank you so much, Lisa.
Now, Congress mandated both DOJ and the CFPB to enforce the Equal Credit Opportunity Act. And of course, both of your organizations work closely to advance the law and promote the law. And we heard a little bit about that from Attorney General Garland, but can you go a little bit deeper and describe for our audience what your distinct roles are relative to this law, and go a little bit deeper on exactly how you work together to enforce the law?
Well, let me start by saying, first, a big thank you to the National Fair Housing Alliance, but also to really build on what the Attorney General has said, which is that we have now 50 years of this law under our belts. And while it has been an important and powerful tool, we have a lot to do to realize the promise of it. And I think a place that we know that both the CFPB and the Justice Department will need to be ready for is to ensure that when it comes to old school discrimination, we stamp it out, and that we don't allow the digital discrimination of the future to become widespread and systemic. And one of the things we really rely on our partners at the Justice Department is to be with us to prosecute wrongdoing across all sorts of misconduct on credit discrimination. And one of our jobs is to make sure that we are looking inside the banks and other mortgage companies, lending companies, others, in our inspections and examinations, as well as to make sure that the rules are clear for the digital future. So we have had a record of prosecuting a number of bad actors who engaged in terrible discrimination, but to not just look at the old school, to look at the future, as well as an important practice called predatory targeting. So I really see what we do as very symbiotic. We have different roles, but the things we do together to chart and stop the future of discrimination have been just so high on our agenda.
And, sadly, modern day redlining persists in our country. So I'm very proud of the whole of government approach that we have been taking to addressing redlining. And for us at the Justice Department, the Consumer Financial Protection Bureau under Director Chopra's leadership has been a really central partner in this work and in our efforts. As the Attorney General noted, we launched a nationwide combating redlining initiative, and this initiative truly marks the most coordinated effort that the Justice Department has had to date to address redlining. We are working with our sister agencies, including not just CFPB, but the Office of Comptroller Currency and others to access data that is directing us to the places where government enforcement is needed most. We, to date, have secured over $152 million in relief, and this is relief that is flowing directly to impacted communities. It is relief that is helping to open up new branch office presence for banks in places where bank presence didn't exist before. This is relief that is providing loan subsidies that is helping to open up pathways to homeownership for communities that have been previously denied access. In addition to that joint enforcement work, another big issue that we have been tackling with our government partners, including CFPB, is the problem of appraisal discrimination. We know that a significant gap exists between how homes are valued in communities of color vis-a-vis predominantly white neighborhoods. On average, homes in majority Black neighborhoods today are valued at less than half of homes valued in neighborhoods with few or no Black residents. That is a problem, and that is an issue that we need to stamp out. And coming back to this whole of government approach, under the last few years, 14 federal agencies have come together through the Interagency Task Force on Property Appraisal and Valuation Equity to confront the problem of appraisal discrimination. That effort, I think, really is historic and marks new efforts being made today to confront the issue of discriminatory appraisals, which rob too many homeowners of the true value of their homes.
Rohit and Kristen, thank you so much for that explanation. And am I correct? Now, so let me just say one thing. For those of you who know me, you know this. I go back a long way. That is a very nice way of saying that I'm a senior citizen. And so I remember when I used to do a lot of investigations and working on cases that we would funnel information to the prudential regulators like the OCC and the Federal Reserve. And then those federal agencies actually made referrals of fair lending cases to the DOJ. And I just am wondering, does that practice still happen? And Director Chopra, do you at the CFPB, do you all get referrals as well?
Yeah, so the law states that those entities, and they mostly are supervising smaller banks and credit unions. That is true that they make referrals to Assistant Attorney General Clarke. The CFPB, we have all the non-banks, the largest credit unions and banks, which is around kind of 92% of mortgage lending. I don't know the exact number. We can directly prosecute them as well. And I think in practice, because of the Attorney General's initiative, we have really focused and figured out where do we go together, where do we go separately. And I think you can see each agency has really developed a stronger record on really combating some of these worst practices, and the numbers really speak to it. But I would say this, I think it was an important reform to have the CFPB on the hook for a lot of this responsibility, because for too long we saw how the role of equal credit and fair housing really was at the bottom of the list. And now both the CFPB and the DOJ are highly accountable to make sure that we're actually doing our job.
Kristen, anything you want to add to that?
No, just as you talk about referrals, I want to take the moment to underscore our partnership with other entities like U.S. attorneys' offices across the country that are often our boots on the ground in terms of identifying banks and lending institutions that may be running afoul of ECOA and NFHA. But we absolutely rely on referrals from advocacy groups, impacted people, law enforcement partners, and more.
And so in talking about this sort of partnership that you all have, one of the other things that comes into play here is the HMDA data, the Home Mortgage Disclosure Act data, which the CFPB has a very major role in enforcing and implementing in our nation. And I'm just struck that it seems every single year, because I remember when HMDA was first enacted and we first got the first batch of HMDA data in the late 1970s. And every single year when the HMDA data is released, we see the same pattern over and over again, that people of color get denied for mortgage credit at much higher rates than their white counterparts. In fact, the Federal Reserve Bank of Minneapolis just released an analysis that shows that for Asian applicants were denied at a rate that was 70% higher than their white counterparts. The denial rates for Latino applicants was 93.3% higher, and for Black applicants, the denial rates were 147% higher than their white counterparts. And these disparities remained after controlling for really critical characteristics like income and credit score and loan to value ratio. So these are the kinds of practices that ECOA was enacted to help address and minimize. What are your thoughts about why we are continuing to see these kinds of disparities? And then I guess it begs the question, are we putting enough resources behind in enforcing this really important law?
So, Lisa, I think it is a little bit of a pipe dream to think that the Equal Credit Opportunity Act has solved some of these things. It has been very powerful, but we know there is a lot more to do to fix this. And the Assistant AG mentioned something, the issue of appraisals, which I think has been a very pernicious factor when it comes to wealth generation, but can also contribute to higher levels of denial in a number of neighborhoods across the country. So the way I like to really think about this is we have a system of banking and mortgage lending. Banking is really about we pool our deposits together for public purpose to lend to the community. But we know that those deposits are often shipped far away, often not to households or Main Street businesses. But the HMDA data has actually been a critical accountability mechanism. And it does mean that companies are checking their own math in terms of who they are lending to and why they aren't lending to certain individuals. I raise this because I think without that data set, those numbers, Lisa, would be way worse. And also right now, the CFPB has finalized some rules that would make that data available for small business loans. And we know that small business lending is another place where discrimination occurs. It is a major gateway to wealth creation across the generations, and protecting the HMDA data and figuring out what the future of it is a lot of high stakes, not just for companies and lenders to do the right thing, but also for law enforcement to detect and deter wrongdoing. But the answer is a lot more needs to be done.
And I would say, thank goodness for the Home Mortgage Disclosure Act, HMDA data, which provides a level of transparency that we have about how banks and financial institutions operate, who they loan to, who they don't. It gives us a way to compare banks to their peers to figure out why they may be outliers. So it, the HMDA data, I think, is incredibly important to enforcement work. But equally important to looking at the data is looking at the actions, looking at the policies maintained by banks and financial institutions. We have found in the course of doing this work that there are some lenders, for example, that don't implement policies that ensure fair treatment of borrowers. We have found institutions where loan officers are not providing equal assistance to applicants who may need guidance on how to navigate the loan process or how to raise their credit profiles in order to qualify for loans. So the data is just one piece of the puzzle. By way of example, the Justice Department had a recent enforcement action involving Bancorp South Bank, which illustrates a lot of what I'm talking about with respect to both data and policies being really critical to understanding who is complying with the law and who's not. Along with our partners at CFPB, we investigated the bank and found that the bank gave a lot of discretion, maybe too much discretion to staff at the bank to decide whether or not to approve a mortgage loan application. They did not require staff to consider credit scores or to document how a borrower's loan characteristics influence their decision in the review of an application. We also found that the bank maintained a policy of not providing applicants of color with as much assistance as they provided white applicants. And this was confirmed by an audio recording of an internal meeting revealing that the bank instructed loan officers to turn down applicants of color more quickly than white applicants, and to not provide assistance to so-called borderline applicants that other applicants may have received. So the data is key, but equally important is understanding, what's happening behind the scenes. What are the policies? What are the actions that may be contributing to this problem of modern day redlining?
And Kristen, thanks for sharing that example. One of the things that I'm struck by is the pushback that I see a lot, because we, at the National Fair Housing Alliance, we do a lot of work with the lending industry on a number of fronts. And I'm often hearing complaints and pushback about some of the cases that DOJ and the CFPB have advanced. Some argue that the agencies have used too heavy of a hand in enforcing the law. The use of ECOA, for example, the Equal Credit Opportunity Act, to address redlining practices falls in that bucket. There are some lenders who believe that ECOA cannot be used to address redlining. And I should say, this issue came up in a recent case in the Townstone matter. And in full disclosure, NFHA wrote an amicus brief in that case arguing that indeed ECOA can be used to address redlining issues. But I'm just wondering, what are your thoughts about these sort of assertions, these claims that the DOJ and the CFPB are overreaching when it comes to ECOA enforcement?
Can I just say, the idea that the Equal Credit Opportunity Act was passed to not combat redlining is weird. The whole point was that there was a government policy as well as a practice in the industry of literally not lending to certain neighborhoods. And where people are suggesting that the law passed with that as the primary concern wasn't meant to address it, it's just strange. And so I think we need to recognize that we can't just wipe away history, that history exists, and it should continue to live on as one of the foundational reasons why this law exists. If anything, the act was not just about mortgages, it was also about other forms of credit. And I think that we know that there are several other places where credit is not fairly lent. And that's going to be a place that if there was physical or digital redlining in violation of that law, and I want to thank you for your brief and the Townstone decision, which ultimately led to a unanimous decision by the panel affirming the ability to combat redlining in that way.
Yeah, I echo those points. And, it's worth pointing to the simple text of the statute here. The Equal Credit Opportunity Act's plain text prohibits discrimination in, quote, any aspect of a credit transaction, which would include things like pre-application discouragement of applicants. So we're pleased with the outcome of the Seventh Circuit decision, which unanimously agreed with the longstanding interpretation that ECOA covers prospective applicants. I think this is, just simple common sense. Any other result would be nonsensical. It is worth underscoring that one reason why lending discrimination is so pernicious and widespread today is because people and communities often don't know that they've been discriminated against. Prospective applicants are especially not in the best position to know if they've been discouraged from applying for credit or if a lender has specifically avoided lending to their community. The informational asymmetry when it comes to prospective applicants is very real, and it places more responsibility on us, on enforcement agencies, to do the work to identify and root out discrimination in the pre-application process. So ECOA remains a really critical tool in this important work that we are doing to ensure that we have a fair and level playing field when it comes to our economy.
Thank you so much, Director Chopra and AAG Clarke. Yeah, it does seem weird. That argument does seem weird and nonsensical, especially when you look at the purpose of the law and take a look at the congressional record behind in terms of the discussion about the aims of the law and the goals of the law. If you're discouraging people from applying, you're limiting their access to credit. You mentioned, Kristen, that this concept of asymmetry, right? That it oftentimes is hidden, and Rohit, I've heard you talk about this too, that discrimination can be very hidden, right? It's not always clear. If a person is being discriminated against, the perpetuator of discrimination isn't going to be announcing, hey, look, I'm discriminating against you. And so we can use tools, investigative tools, to sort of uncover and suss out discrimination. Some of those investigative tools include testing. And I know that both of your agencies have, DOJ has been doing testing for decades and decades. In fact, the National Fair Housing Alliance wrote a letter to Congress to support funding for DOJ to do testing. And Rohit, this is something, it's sort of a newer advent for the CFPB, but I'm wondering if both of you will speak to this role of your testing programs. And I know that, in fact, the CFPB just produced a paper just a couple of weeks ago about a testing pilot that you all did in the small business space. So Rohit, I'd appreciate it too if you talk about the results of that and the role that testing can play and why it's so important and critical to your work. Kristen, do you want to kick us off?
Yeah, we're very excited about the work that we've done with CFPB on conducting match pair testing in the small business lending context. And I'll let Director Chopra further elaborate, but as many folks know, testing has been a critical tool for rooting out bread and butter discrimination that we see in the housing market. It has been a critical tool for identifying discrimination faced by prospective tenants seeking access to fair housing opportunity who are often discriminated against because of their race or familial status. So we're excited about the work that we have done here, and I'll let Director Chopra elaborate further.
Yeah, I'll also build on what the AAG said about that asymmetry. I mean, we know that there are not always going to be receipts for discrimination. There may be no paper record at all. And in fact, with redlining that took place in the past, the original redlining that was uncovered decades ago, that really just meant that there were no applications coming in. And so one of the things that we released a few weeks ago was an analysis of that type of secret shopping or testing, where we had individuals seeking small business loans. And what we found in that pilot, and this was really interesting, that instead of being directed to a small business loan opportunity, we actually found that many of the African American prospective borrowers were actually told, oh no, why don't you look into a credit card? Or why don't you look into a home equity loan? And that's the type of thing where maybe they did submit an application for a home equity loan to finance their business. That wouldn't be captured in the data about small business lending. So it's important to understand how people are turned away or discouraged. And this is just another tool we've taken. This is something that is used across law enforcement, and I think it has really proven to be something that is very valuable.
Thank you. And it also strikes me, some lending financial institutions also use mystery shopping and testing.
Many do, in fact, many want to make sure that their policies that they put on paper are actually being followed in the locations where it's happening. And by the way, this is in every single sector of the economy. There are those who are secret shopping, even at fast food restaurants, at so much more. So this is a tried and tested tool that I think will be it's valuable even for companies to be making sure that they're giving the quality service in a fair way.
That's exactly right, Rohit. And I would be remiss if I didn't say that we work in tandem with a number of financial institutions, including insurance companies, who not only utilize mystery shopping and testing to make sure that their associates are complying with the law and doing the things. Kristen, you mentioned that, organizations may have policies in place, but actually implementing those policies in real time is something completely different. And one of the things they're trying to suss out is, like, are our employees actually implementing the policies as we think they should be? But I'd be remiss if I didn't point out that there are some of our lending partners that use ECOA to fine-tune their policies and practices.
Which is what we want, right? We will not enforce our way out of the crisis of modern day redlining that we face. It is important that banks self-regulate, use the data to figure out where there are breaks in the system. Look to settlement agreements secured by the Justice Department and by the Consumer Financial Protection Bureau to find the roadmap to reform. Don't wait for a federal or state law enforcement agency to come knocking at your door. And so, you know, for the folks who are joining today who may represent financial institutions, I think it's really important that we encourage that theme. Use the data to figure out, are your systems working, or are there breaks in the system? We spend a fair amount of our time outside the enforcement context, attending webinars and training sessions with banks and financial institutions, precisely for this purpose of encouraging them to figure out how they can course correct and address problems before they reach a crisis level where you've got federal or state law enforcement agency knocking on the door.
So we just have a couple of minutes left, and I have one final question that I want to put to you both. Um, eh, eh, Rohit, you mentioned earlier about sort of the future of fair lending and the way that your agencies may have to be addressing these kinds of issues in future. And what that springs to my mind is discrimination around automated systems, AI systems, algorithmic bias. You guys have both heard me say that AI and technology is the new civil rights frontier. We are only going to see further uptick and an increase in use of AI systems. And right now we know that automated underwriting systems and risk-based pricing systems and credit scoring systems, marketing systems are all perpetuating bias. That's part of a lot of the work that we do at NFHA with our responsible AI division. And I wonder if sort of in closing, if both of you would speak to this particular angle of enforcement of the law and how you think, whether or not you think ECOA is robust enough to address some of these future fair lending challenges.
So I'll start. This is a big one, and we could talk about this for a while. One of the reflections I have, Lisa, is that mortgages, housing, credit, it's actually been using algorithms for a while. You could even think of the FICO score as an opaque algorithm that uses artificial intelligence. I mean, these are all things that we are used to. We know that when tenants show up to apply, they are often subject to an algorithm by tenant screening companies. We know that companies hire advertisers to use very carefully curated behavioral targeting information to offer products and services. So I think the way we have to think about this is really what is different. And what is different in my mind is really the use of generative AI, the fact that we may have things like chatbots or others that simulate human interactions where the bias is baked into the machine, that they know a lot about you before you even submit a paper application or an application online. So I do think that we have tools under the law to combat some of this, but we, not just enforcers, but all of us who care about this, need the technical know-how. And we at the CFPB have brought on a substantial number of data scientists and technologists to help us really dig into some of these models that are changing sometimes even minute to minute. So having a clear sense and being upfront that those algorithms and AI still need to follow existing law. We have made it clear that the Equal Credit Opportunity Act and its regulations require those who are using automated decision models, those who are using AI, to tell people the reasons why they've been denied credit. And if you can't tell them the reasons, you can't use your fancy technology. So there's a long list of things that we have to do to be ready for this. I do think that when it comes to advertising and marketing, an algorithm can also redline. When it comes to actual underwriting and all sorts of proprietary scores that are used to put people in buckets to determine whether they get a loan, that is ultimately a challenge that we will have to deal with as an entire enforcement community, as well as preparing our laws to see if they need some updates. And there are probably places where we need to strengthen our federal and state laws to stop the worst of some of that generative AI-driven discrimination.
Yeah, I agree. There is room and opportunity to think about what are the additional tools in the arsenal that can help us confront some of the challenges that we face in a world where we are seeing increased reliance on use of automated systems and other innovative technologies. But it is worth underscoring that the tools that we do have, most notably the Equal Credit Opportunity Act, is robust enough to address the present day challenges that we face. And it is why last year that the Justice Department, along with CFPB, the Equal Employment Opportunity Commission, and the FTC teamed up to issue a joint statement pledging to confront bias and discrimination in automated systems, and made clear that existing laws, the Fair Housing Act, the Equal Credit Opportunity Act, that these laws apply to the use of automated systems and innovative new technologies. We've filed briefs in courts that have helped to make that same point. Algorithms have an incredible power to, generate more room for opportunity, but it also brings with it risk. And I think it is important that we take time today to urge lenders who are listening to be proactive and to make sure that you are constantly reviewing and testing your underwriting processes to ensure that credit decisions do not turbocharge discrimination by disproportionately rejecting loans to applicants for reasons that are not related to credit worthiness.
Well, Director Chopra and Assistant Attorney General Clarke, thank you so much for your leadership and your commitment, and for joining me today for this important discussion. We appreciate it so very, very much.
Thank you.
And now I'm going to turn the reins over to Anthony Coley, whom we all have had the pleasure of watching on MSNBC and CNN and other news outlets. Anthony is a trusted advisor to Treasury secretaries, CEOs, civil rights experts, and other leaders. And prior to joining MSNBC and CNN, Anthony was actually the head of public relations and public affairs at the U.S. Department of Justice. So he's the perfect person to lead our next panel. And Anthony, I'm going to turn it over to you.
All right. Well, thank you, Lisa. Before I let you go, you can hear me, right?
Yes.
All right. Lisa, thank you so much. The first time we met for the first time today, but I know Lisa by reputation. I first became familiar with Lisa's work and her expertise during the implementation of the Dodd-Frank Act. When I was at the Treasury Department during the Obama administration, I followed Lisa, your work ever since. So thank you. And thank you to the board and the staff of the National Fair Housing Alliance for having me today. So, folks, we have about 30 minutes to go. And I want to spend the next segment, the next bit of time talking about the way forward. So if all of the panelists can now join me on the screen. I see Morgan there, Amy, there's Ken. Morgan, I'm just going to start with you. I'm going to introduce folks quickly, and then we can get into the meat of this conversation. Morgan Williams is, of course, the General Counsel of the National Fair Housing Alliance. One thing I appreciate about Morgan, about what you and what everyone does is that you all don't just sit back and file an amicus brief just here and there, right? You all are on the ground. You're pursuing pioneering litigation under the Federal Fair Housing Act, and Morgan leads that effort here. Ken Scott also joins us. He's on the board of the National Fair Housing Alliance. He's also a partner at Relman Kofax, where he counsels financial institutions on best practices for complying with fair lender and consumer protection laws. I would be remiss to say, if I did not say that Ken is also a two-time alum of the Justice Department. So Ken, thank you for being with us. And so much about what this organization does is in the States. It's outside of the Beltway, which is where I am, where Lisa is. So Amy Nelson is here with us. She's the executive director of the Fair Housing Center of Central Indiana. Amy has literally spent her entire life, professional life, on the ground fighting for fair housing and equal rights. So thank you all for joining us. We got, again, about 30 minutes. I want everybody to stick with us. I'm going to jump right in. I have one question for the entire group. And Morgan, I got to do my setup first, but Morgan, I'm going to come to you first, all right, after I do my setup. So much about what we have heard is a result of over the last hour or so is a result of this organization's advocacy and because there have been cops on the beat, right? But what happens when that's not the case? What happens when the cops fall back? And so, again, the question for you, Morgan, I'm going to start with you, then Amy, then Ken. What concerns you the most about the incoming administration, and in particular, the Heritage Foundation's Project 2025? Morgan, kick us off.
Thanks, Anthony, and thanks everyone for being a part of this discussion. There's probably a lot of ways to answer that question, so I'll take a crack at it and appreciate that Amy and Ken may have other angles. But a part of what we heard in this discussion from our federal agency partners is that there is a persistent need to continue to enforce our nation's civil rights laws, including our central fair lending law, ECOA. The radical conservative agenda that's focused on dismantling civil rights protections because they're a perceived threat to a white America is a misguided understanding of the significance of civil rights in expanding housing and lending markets, ultimately serving as an engine of economic development. In fact, fair lending is a bipartisan issue because fair lending is economic development. For the purposes of preparing to work with the next administration, we would have a clear message that's consistent with the work we do day to day, every day. Fair lending makes business sense because it involves taking measures to expand credit access and market services to previously underserved communities, thereby growing industry through more expansive revenue-generating activities. And 70% of all future household growth will be among communities of color. Therefore, it's an economic imperative and a core safety and soundness concern for the housing sector to ensure that borrowers with a range of credit profiles can fairly access credit opportunities. So in response to the question, Anthony, about my concern, it isn't a concern, but what I perceive, I guess, as an opportunity and a challenge that as civil rights advocates with our industry partners, that we may work with the incoming administration to ensure that they understand that this is economic development is also at the core of the nature of the work that we do.
I appreciate that. I'm still concerned, Amy. I think I understand Morgan's optimism, and I think that's the right tone. But for the 200 or so people who are on this call right now, I think there's a bit of nervousness, particularly when the cops fall back. So what concerns you?
I will say that I will speak kind of more generally about where we see potential barriers to home ownership access,
Okay.
specifically with mortgages. And some of this was discussed a little bit in the previous panel, but we have seen a lot of work being done on appraisal bias. Although I would have wanted this administration to do much more to
Right.
tackle that issue. It was an administration that did acknowledge that this bias existed and kept it
Right.
within the news. I don't want us to see loose footing there. I also have a lot of concerns about investor impacted initiatives in our home ownership markets, and how we are becoming a country that very quickly could be completely owned by Wall Street, therefore impacting the ability of individuals to become homeowners. We, in the previous panel, talked about concerns on redlining. We don't want to see
Sure.
those initiatives roll back, nor the work when it comes to special purpose credit programs. I will say here locally, our organization has certainly challenged some low performing lenders. And out of that, we've been able to advocate for special purpose credit programs to try to close home ownership gaps. And we had seen some efforts where these programs would become more people-based, not just majority minority community-based, so that somebody, a person of color, could take that product and go into a white neighborhood and integrate a neighborhood. We don't want to see that fall away. Last two things I'll just bring up quickly, because we may talk about them a little bit more later, is concerns we have around the use of land contracts for home ownership, and how these forms of alternative financing are just simply built to fail. There's a lack of work around trying to advocate for better I-10 programs when it comes to buying homes. And then the last thing I will say is homeowners insurance. Individuals with mortgage need to have a fair and affordable product in order to have their mortgage. And we are seeing a problem nationwide, and we will certainly be advocating this area with the next administration to try to address our homeowners insurance crisis, to make sure people don't end up in foreclosure or selling their homes simply because they no longer can afford the insurance on it.
Got it. That makes a lot of sense. Ken, what about you, buddy?
I would agree with everything that Amy and Morgan said. And I want to thank NFHA for putting on this event and Anthony for hosting us today. But where I come at this is when you look at the financial institutions and you look at what they have gone through over the last, say, 10 years since 2008, many of them, I am hoping, have learned that as you go through these political cycles, that when you invest in compliance based on political cycles, it does not work well for you. And I think all of us on this call, both the financial institutions and us all working, need to keep our foot on that message, letting folks know that we need to keep working to make sure that these financial institutions have robust compliance management systems. And we heard AAG Kristen Clarke says, we can't enforce our way out of this, right? We've got to keep the regulation piece of it on it. And I think that's what people like myself, Morgan, Amy, and others can find people within these institutions that understand this historical line that I'm talking about, and really work with them to keep doing as much self-regulation as they can, and also remind them at the end of the day, 5 years from now, they'll be judged by what they did in the previous 5 years. So if they took their level, there's going to be an issue.
Right. So Ken, I want to stick with you for a minute, if I can, to talk about private enforcement. We heard a lot from the Attorney General early on talking about DOJ's work combating their combating redlining initiative. I was at the Justice Department when Assistant Attorney General Clarke announced this initiative. It has literally changed lives. But based on, I'm like a dog with a bone because I'm doubling down on this thread from my first question. I just don't, based on what I've seen in some of the policy documents, particularly Project 2025, I just do not expect the Trump administration to continue prosecuting these civil rights claims. In particular, to be specific, we know that Project 2025 calls for a retreat from fair lending by abolishing the CFPB. We know it wants to eliminate special purpose credit programs. We know that officials want to terminate Treasury employees who are engaged in diversity initiatives. So for you and for Morgan, talk to us a little bit about the role private credit has played in ensuring access to credit-free discrimination and what role it may play in ensuring compliance with the Equal Credit Opportunity Act and other fair lending statutes.
Well, I'll take it. I know Morgan is going to have way more than I would have on this topic, but I think this is because there's just so much to talk about here, right?
Right.
The federal government may stand back, but then the state AGs that we all work with and are working with states, we need to work with them. They can enforce the ECOA, they can enforce the Fair Housing Act, they have their own state fair housing acts, they have their own state. It's similar, ECO. There are a bunch of other levers that we have at the local level that we can use, right? Then we have NFHA and other institutions and all the member organizations of NFHA that are out on the ground, and they're going to be identifying discrimination. I mean, it's clear, it's out there. We see it in the news every day, and shining a light on it. And, there are some challenges right now as we're thinking about how we need to bring private litigation, particularly as organizations are doing this work. But we need to be really thoughtful as to how we thread that needle to make sure we can have organizations like NFHA, have organizations like the Fair Housing continue to do their work on the ground, and for us to bring that private litigation. And then on the SPCP side, we've done a ton of work over the last 3 years. And, I thank the CFPB, I thank HUD, I thank DOJ and others that have leaned in and really created a climate where we can use special purpose credit programs to expand access to credit. And institutions that don't have special purpose credit programs now, when we do their HMDA analyses, they are going to have a smaller credit box than everybody else. And they're going to have shortfalls vis-a-vis everybody. And I remember what I said, you're going to be judged over the next 5 years. So our message to folks today is, you don't want to start pulling back from your special purpose credit programs, all right? You may, and we have not seen any litigation on that front. So lean in on them. I think, there's still a lot of opportunity there. There's still a lot of work that can be done. And, they provide a lot of benefits.
Thanks, Ken and Anthony. I think Ken hit a lot of the main points, I think, about where we're going to have to pivot here. The robust and really commendable nature of the ongoing DOJ and CFPB redlining docket suggests that, as was noted, much work remains. That there exist current institutions that may face redlining liability on the basis of their performance over the past 5 years. Regardless of how the next administration directs their enforcement resources, private advocates and litigants may play a powerful role, as Ken noted, in coordination with state AGs and others. Did want to flag that we prepared a redlining toolkit in April of 2022. That's a document that details the redlining risk factors that present ECOA and fair housing risk for banks in regards to their servicing of Black and Latino neighborhoods in their communities, including what an advocate or lender may consider in analyzing HMDA data and considering other modern day redlining risk factors. That's a tool that we created for advocates that may consider private enforcement moving forward, or that lenders may find as a resource. Those who may be, smaller, not have robust programs, or that, may want to use it as a training resource or otherwise.
Great. Thank you for that, Morgan. I want to shift, if I can. We cannot have a conversation about the Equal Credit Opportunity Act without talking about gender inequality. So for Amy, for Ken, if you can, take this next question. Equal Credit Opportunity Act was passed to challenge gender discrimination against women when accessing credit accounts in their own name. And it allowed women to build credit profiles and leverage credit for innovation and economic development. Right? Some of the most explicit barriers restricting women's ability to access mortgage and small business loans have been challenged in the last 50 years, and that's a good thing. But women still face very real barriers to equitable access to credit when seeking home ownership. So my question for you, Amy and Ken, how can this law be an effective tool for addressing sustained gender inequality in the mortgage lending industry?
Well, in digging into some recent, data from the National Association of Realtors, we saw that 20% of home buyers were single women compared to 8% for single men. So we see some gender disparity there. But women are staying in their homes. We saw an increase in the rates of sale by married couples. For single women, decrease. So they're staying in their homes. And I found that another interesting data point was also the increase in purchases by cash. Again, I keep coming back to this impact of Wall Street-backed investors. Homeowners are having to come in with large amounts of cash in order to be able to compete. So looking at this gender inequality, one thing is a reimagining potentially of credit scores. We see this in disparities, certainly as it relates to people of color because of the bias within the credit scoring system. But we need to also remember that there is a huge gender pay gap in this country. White women, Asian women, 80 to 90 cents on the dollar, while Black women and Hispanic women, are at 60 to 70 cents on the dollar. That's got to be reimagined. I also have concerns about reverse mortgages and how they are marketed, particularly to older homeowners, and whether or not they are some unscrupulous actors coming in and targeting individuals with marketing ploys. I'd like to see more effective homeowner repair programs. That probably isn't an ECOA issue, but I want to throw that out there. Let's not displace individuals, particularly in their elder years, that are connected to our neighborhoods. Let's keep them in there on that. So I think we also need to advocate for smaller homes and a variety of different things, but just very quickly, a few of the items I wanted to mention.
Right. That issue of reverse mortgages, man. I am from rural North Carolina, and I was back home with my mom over the weekend. I am really concerned about this. Number one, they just have these catchy jingles, and before you know it, people are signing up for things that may not be in their economic interest. So I think you hit the nail on the head right there. Ken, what do you have anything else to add here? I'm mindful of the time. I have a long list of questions.
I will keep my remarks concise.
Okay.
A couple of quick points, right? There is a lot of work left to do on assisting women to get into homes, not just homes, but just getting credit generally, credit cards, personal loans. It's across the board. But there are some good news things, right? A couple of good news things. We have special purpose credit programs. We're seeing on the small business side, there are many special purpose credit programs that are available for women and minority-owned businesses, which is very good. The flip of that, though, is we're not seeing very many special purpose credit programs on the mortgage side directed to women directly. And we know many of those programs come with down payment subsidies, and assisted closing costs, which would be beneficial. And another cost that has come out of the last thing is the whole attack when HUD and the CFPB and DOJ and others have worked on making sure women that are taking time off for maternity leave are not disadvantaged. There's no
Right.
that's having a child should be disadvantaged because she's having that child. And I think a lot of lenders have gotten that message. I know Fannie Mae and Freddie Mac have updated their guidelines to reflect it so it doesn't disadvantage women, but there's still a lot of opportunities out there. And I won't go through all of them, Anthony, because as you said, in the interest of time, I will give you some time back.
That's great. Maury, is there anything you want to add here? Are you good? Ken, is there
No,
anything? Go ahead, Maury.
No, you go ahead, Anthony, please.
Okay. So Ken, before I shift to kind of more economic development issues, is there anything more you want to say about special credit, special purpose credit programs in the context of mortgage rate disparities for Black and Hispanic households?
I don't think it really goes to the mortgage rate disparity piece of it in a sense,
Okay.
because I think one of the things we've seen recently, and I think it was the FHFA came out a couple of weeks ago with a report that showed that we're at an all-time kind of, when you look at kind of the GSE's rates across the board, and I may be not capturing this right, we're actually at a point in time where those disparities on pricing are actually very low. All right.
Right.
But what we're seeing, and we still need, is the barriers to entry are the closing cost assistance and the down payment assistance. And that's where the special purpose credit programs are very helpful. So when you see banks working with people like NFHA and others to come up with these partnerships where they're having these down payment assistance programs and others, we need to let everybody in our communities know about that. We need to spread
Right.
the word because we want people to use that money to help close the home ownership gap that we've been talking about throughout this webinar today.
Right. All right, so we've got about 10 minutes left. I've got my final two questions that we're going to go to. I'm going to open it up to all panelists. The first deals with economic development. Amy, you talked a little bit about market equity early on. So this is a question for the group. How has ECOA been a story of economic success, and how can it be used to further expand credit markets as a tool for economic development?
I'll jump in. One of the things I've mentioned this role of Wall Street backed investors. People with mortgages aren't able to compete as effectively just because they're using a mortgage. Do we
Right.
need to think about reimagining a mortgage and what it is so that it's a product that can compete more effectively? Nobody's doing FHA hardly anymore. It's a product that just isn't competitive on the market, especially in hot markets where you've got a bunch of offers. It just gets wiped off the table. We've got to maybe reimagine the products that we're putting together. Again, for our undocumented, we need to have more lenders doing ITIN programs that are targeted alternative forms of financing by reputable lenders to make sure that they are safe products. And those individuals have very low default rates. So we want to make sure that they stay in products that are successful there as well. And then I will just, kind of add in this issue of land contracts and alternative financing. ECOA can be of great assistance in this particular area in making sure that these are safe products that are not otherwise built to fail.
Anybody else?
For me, I want to kind of shift gears just a little bit, Anthony. We're going into a very interesting cycle, and I find language is very important. And the language we use over the next 4 years and how we talk about our issues can either shut the conversation really early, or at least lead us to have an engaging conversation. And when we're talking to people and we say things like, you're starting a business, and the person says, well, I'm starting a lending, I want to lend to as many people as possible. And you say, okay, how are you going to do it? And they say, I'm going to do it this way. And I say, hey, but if you do it this way, you're going to cut out a whole group of people that are going to make you more profitable. And they say, okay, let's do it. Well, maybe you should think about it another way. I just talked about it and used language around the disparate impact theory where I did not mention the word disparate impact in talking about it, right? And I think how we talk about it over the next 4 years and thinking about trigger things is going to be very important in moving our agenda forward, because we don't want to close down the discussion before we can have the discussion.
Right. Morgan, anything else on the credit part of this?
Building off of that. Yeah, I mean, I just, industry changes that were triggered by fear of ECOA liability over the past 50 years and even in recent years have made industry players better at their jobs.
Right.
Though much work remains, I mean, the industry has improved at identifying qualified borrowers across neighborhoods. It's learned to use a finer scalpel in separating, good risk rather than relying on broad categories. But the industry is really at a pivotal point with technology. And next administration aside, the change is happening in the industry, and that presents, profound new challenges, as was noted by our agency partners, but also opportunities to really affirmatively expand access to credit, and really consider a more affirmative marketing. Like, there's a lot of really good work to do. Next administration's priorities on these issues aside.
That's right. All right. So when I take on a new client, I always start with the question that I'm about to pose to each of you, right? Over the next 4 years, what does success look like? And what can the people on this call do to bring that about? Who wants to take that? This is my last question. So, Ken, why don't you kick us off?
I drew the short straw, no problem. I think success for me is, we continue to be able to engage with people and engage with folks, the 49 or 50% of the country that, put this administration in place, understand some of their issues and hopefully help them understand some of our issues, and, kind of change.
So I just heard listening. matters.
Listening,
and it's a two-way street, right?
Listening and tone going forward are going to be very important. And I'm all about the conversation. If I'm not talking to somebody, and if I'm only talking to people that think like me, that's a bad day, right? So it may be hard conversations, but we need to have those hard conversations. Otherwise, we're not going to be able to find middle ground. So I would say listening is key for me going forward over the next 4 years.
Amy, you want to take the next one out? Since Morgan is the host, the representative of the National Fair Housing Alliance, we'll give him the last word.
I agree with Ken. Stay informed on the issues, be engaged, share the information that's important. Get involved with your local fair housing organization. We always need fair housing testers. And so there's ways to be engaged, in that capacity. Also, you can also work at your local city, county council level with state lawmakers about expansion of down payment programs, or educating the public about where we may see barriers or affordability problems. We certainly have seen, even, in our state of Indiana, a growing coalition of people engaged on housing issues, whether that is on the rental side or on home ownership, as we've seen more people become limited in their ability, become homeowners and build generational wealth, that impacts everybody.
That's right.
In addition to these great comments, Anthony, I'll just add, again, to the extent that the future of ECOA lies in us grappling with the technology changes that are underway, we really need to, I think success in the next few years means shifting from the learning mode that the industry and the regulators and the advocates have been in recent years in this space to meaningful compliance and oversight and enforcement. And I think that transition is going to happen in this tech space, in applying ECOA in a meaningful way, and that's what success will look like.
And with that, I want to thank all of you for joining me for this conversation. Nikitra Bailey, are you with us? I think I'm going to turn the conversation over to you next. Is that right?
All right. Thanks, Anthony. Thanks, Morgan. Thanks, Amy.
Thank you, guys. Good to be with you.
Thank you all so very much. Thank you for joining our commemorative event honoring the 50th anniversary of the Equal Credit Opportunity Act. As you've heard, the landmark law has had a tremendous impact on the lives of Americans, particularly women, people of color, and others. Because of ECOA, underserved communities can now secure a home loan and loans to start businesses. They can also utilize those opportunities to create wealth that can be passed forward over successive generations. This landmark law has helped millions of consumers to fairly access credit and create better life outcomes for themselves and members of their families and communities. This important piece of legislation requires continued enforcement to sustain the progress we've made thus far and push society forward. We want to thank today's speakers, Attorney General Merrick Garland, CFPB Director Chopra, Assistant Attorney General for Civil Rights, Kristen Clarke, MSNBC political analyst Anthony Cooley, NAFA's General Counsel Morgan Williams, Fair Housing Center of Central Indiana's Executive Director Amy Nelson, and Roman Colfax partner Ken Scott. Both Amy and Ken are also NAFA board members. And thanks again to all of you for joining us to celebrate the monumental accomplishments of the Equal Credit Opportunity Act. We are counting on your partnership and continuing the progress forward. Have a great rest of your day.